reduction in the amount of debt relative to GDP among the private sector. Um, and so that's generally a more disinflationary environment because you have low demand for things, or at least slow growing demand compared to the prior trend. And the issue is that, one is that commodity cycles work themselves out over time. So those are environments of say, commodity abundance and low demand. And then the problem is over time, you work through those reserves that you've built. There's not a lot of, not necessarily a ton of new capex coming online. Demand is slowly increasing over time. And eventually you run into the next commodity undersupply cycle, which is generally a more inflationary cycle. And then the problem is you're now running into that environment when you have super high sovereign debt level, right? So you have that tension between you're supposed to raise interest rates when you have inflation, but now you have over 100% debt to GDP, and you have a very highly leveraged system, especially when you look out in parts of Southern Europe, you look at Japan, as well as here in the United States. And so that's where you get that more inflationary type of response, that financial repression, that more rapid increase in the broad money supply, right? So, for example, in the aftermath of the global financial crisis, if you look at a chart of M2, broad money supply, nothing looked unusual about it because you had some money being destroyed from loan defaults. It spiked as high as 19%. They were still holding rates in that like 0 to 2.5% band. And towards the after the aftermath of the war, that's when you eventually separated them. That was after you had significant inflation relative to those interest rates. You had a period of financial repression, significant real losses in treasuries and cash. And we're kind of seeing a similar environment now where the Bank of Japan's holding rates very low, despite the fact that inflation is above their target. You have, the Eurozone's dealing with very high inflation, but they're still trying to manage spreads for those southern countries because you have a fiscal problem and a debt problem. We see the Bank of England come in, they're supposed to do QT. They had to cancel their, the balance sheet reduction speech and start just kind of, doing 2 weeks of QE, despite the fact that inflation is 10%, because they're trying to have not their bond market get disorderly and break all the pensions. And we're seeing kind of cracks in the U.S. Treasury market. We'll see how that develops. But essentially, yeah, one thing that characterizes the end of a long-term debt cycle is a loss of central bank independence and that kind of forced blend of monetary and fiscal policy. Because the reason we think of government bonds as risk-free, I think in the long run, I think right now they're really focused on their inflation objective. But a good example is actually the repo spike of 2019, right? So they were reducing their balance sheet, and then out of nowhere, or seemingly out of nowhere, because some of the analysts I was following were focusing on this ahead of time. But you had a spike in the repo market, and that seemed like not a big deal at the time, but that was the financing that was used by hedge funds, for example, to buy treasuries. Because at the time, FX hedged treasury yields were negative. So Japan stopped buying, a lot of European investors stopped buying treasuries, particularly T-bills. And so you had a supply glut of T-bills relative to buyers. And a lot of that financing was being now shifted to hedge funds with repo. And the Fed had to come in, and first they did repo intervention, and then they actually had to go a step lower into the problem and start buying T-bills, despite the fact we weren't in a recession, and they didn't really have, it was challenging to communicate about that. And that's an example where, within the framework of how regulations are structured around, how much treasuries banks can buy, where all the pockets of finance are, there's only so much that could be done. And so they had to come in and kind of, just cut their own plans short to, keep financial order intact. Kind of like how the Bank of England timing, in the sense that I've described this as like holding a beach ball underwater, right? So as long as we're not solving the structural energy problems, right? It's not just the war in Europe. It's really this kind of lack of capex in energy over the past 5 years or more, as well as some capacity limits of OPEC. That they're kind of near the top end of how much they can produce, and so there's kind of not a lot of new supply with high visibility coming online, and there's not a lot of encouragement for those companies to get it online, and so I think we have a supply side issue here. As we also have kind of the partial end of globalization, right? So we had this like big disinflationary force from the opening up of China, tapping into that cheap labor pool. Now we have rising geopolitical tensions, things like that. So even if that doesn't all unwind, just the fact that it's no longer going in one direction takes away a disinflationary force. So more wage pressure, more energy pressure, and so I think that essentially what they can do is, if they cause, say, enough of a recession, it's possible they could temporarily get inflation back down. But then when you let go, like you're holding a beach ball underwater, you let go, it pops back up. Suppress asset prices for long enough. Some of that, I think, discontent starts shifting to economic, and then you have that more mixed bag. And of course, the other side is, even if they don't get that far, if they just have to jump in and do something similar to what the UK had to do for their gilt market, if they have to reliquify treasuries in some way, there's only so much tightness they can do. Because one thing I've highlighted is that as they tighten and as they strengthen the dollar, a challenge is that all these other central banks around the world, they start selling or at least not buying treasuries, letting them mature off their balance sheet, buying back some of their own currency to kind of, support their own currencies a little bit. And so you have that problem where the Fed's selling, or the Fed's letting them mature off their balance sheet, so they're net sellers of treasuries. The foreign sector's net sellers of treasuries, and banks, due to SLR regulations, they can only hold so many treasuries. So the question becomes, who buy the biggest balance sheets are not really absorbing treasuries, and that has currency devaluation. They can sell some of these assets, and that's one of the feedback loops that eventually causes disorder. And then that makes the Fed have to do some degree of cessation of tightening or reliquification, maybe before they hit inflation targets, or maybe they hit them briefly, like I said, but then as soon as they get their hand off the beach ball, it comes back up.
You did a good deep dive this weekend on the treasury market and who are the buyers, and you just touched on who aren't the buyers. Who are the buyers, and what is the chances that you wind up with a real problem on the supply demand and rates get out of control? Talk a
So
little
we're
bit more
so I
about
think
that.
I think pension funds can be buyers. They can rotate into some of these higher yielding treasuries, especially shorter term, as well as some investors taking bets in the longer end. They might think that this rally is overdone, or this sell off is overdone. So rally and yield, sell off in bonds. They might want to get into that. At a certain price, you do attract some types of buyers. But the problem is that the biggest balance sheets are selling almost mechanicalistically. They're not the biggest balance sheets aren't selling because it's overvalued, or that's not really a judgment of a price. They're selling for mechanical reasons, and you have much smaller balance, and yet you still have limitations on. It's easier to get money to those big pools of capital. That they feel like the system's not working for them. That it's really kind of working for the insiders, the well connected. That just even if it's not intentional, even just the large institutions that just have those closer, and it's easier to give them liquidity than the long tail of small businesses. And so I do think globally, that this system of rates that are below inflation, of seemingly kind of picking winners and choosers, and a bad track record of forecasting inflation. The Fed never predicts a recession, for example, almost by definition, because they could feed it, right? And so it's almost like they can't predict a recession, even if they privately were correct. It's not something they can really say out loud. So it's inherently a politicized organization, which is generally not what you want, but that it's inevitable, even if the person's trying not to be. And so I think we are in a period of structural impairment of central bank credibility,